Bring that ass back like a boom, 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 boom.
Hey, what's up everyone? Welcome to our weekly market overview for the 21st week of this year, May 29th. And we have a long 3-day weekends for US equities. And we had a little bit more time to prepare for our market overview, and there is something interesting I found through scanning more than 700 charts, but I'll get to that in a little bit. So without further ado, session overview. This week looks pretty much like every other week. We have the risk vest, tactical trading environment, the current markets, and then we're going to do a summary. And quite a change from last week's. Risk vest, our signal is still on negative. So the general market, we're still looking at it in negative light. We had a minor buy, so to speak, buy alert or an edge coming up on the 26th of May. And the general market, alongside with the up-down volume, has moved into positive territory. The new highs, new lows, of course, still negative. And stock participation neutral to almost positive reading here, and as I said, I'll show you in the charts, but a lot of stocks were lifting off the bottoms for the last 3 days of the week. Another thing, as far as tactical trading environment, we trade breakouts. Some of them are working, some are still failing, but especially when you're experiencing this lift in the market for the last 2-3 days of the week. Most of the breakouts were actually trading. We had I think 10 or 11 positions, and none of them was in the red. Everything was making progress to the upside. So gorgeous. We are almost tempted to put this on green signal, breakouts are working well, but we still have to remember the macro conditions that we are in. So again, some caution is still advised. And with this, I want to take it to the current markets. We're going to take a look at some charts. I'm going to walk you through some of the internals that make up those signals, so you know what we're looking for when we're coming up with the new highs, new lows, and so forth like that. Then, of course, I have a couple of notes. We're going to do the industry groups, the sentiment, and then we're going to cap it off with a summary. Now, the first thing I want to show you guys are the general markets, and what you will see right now. This is a trade station, and this is my radar screen. Now, for those of you who are not familiar with trade station, this is something like a watch list, and I basically have here futures, main market measured, ETFs and so forth and so forth. We have the sector ETFs right here and equal weight ETFs. Now, just a quick glance at this column right here. These are the last 5 days, so last week. We went from being negative. The last 10 days, you can see if you do a small calculation, right, for the last 10 days, we had 552, we had 409, 401, 421, and now we have 508. So the last 5 days have been really positive. You can see these are the normal ETFs for the spiders ETFs mainly, and I have some more here. And then these are the equal weight ETFs, basically the same as the spider ETFs, but every stock participant gets an equal vote regardless of the price. So you can see equal weights were also performing very well. And another thing that I'm following, crypto, the week has been relatively flat if you combine Bitcoin and Ethereum, and today we had a surge in Ethereum surging by 10%, Bitcoin is 6%, so it's been a great week. Now, if we dig a little deeper into the charts, and let me start with the S&P 500 charts. As you know, this is the advanced decline line. What a sharp rally off the bottom. And right here at the bottom of the chart, you can see the 52-week lows and the 52-week highs. So wherever you see green predominant, that means that more stocks are making 52-week highs. And when you see reds, that means that more stocks are making 52-week lows. And as you can see, we turn up green again here. That's on the S&P 500. And one thing that I really want you to notice here is that there's divergence. The market is making a lower low right here with this wick, but the advanced decline line is actually making a higher low. So that's a very basic form of divergence, but at least the advanced decline line is pointing to higher grounds. And if you look at the advanced decline line, it's almost touching this point right here, which is at 4,300. Now, another thing that, and I think, okay, right now is probably the good place in this presentation to show it to you. If you're looking at our VIX reading, and this is the volatility index that's we are, putting into our calculations as well. The upper part of the Bollinger Band for the S&P 500 is 424. I said 430. We're looking at 430 right here. According to the advanced decline line, let me bring it back. So you see advanced decline line is making a high tip right here with this at 430. So 430 is probably something to look for. And on the VIX chart, so this is the S&P 500, this is the VIX. So on the VIX chart, we're looking at 424, 425 here as an upper bound for this bounce. So in this sense, the advanced decline line and the VIX signals that we are getting are basically telling us the same thing. Now, since we're on the chart, VIX is making lows, but also be reminded of that is almost hitting the lower Bollinger Band right here. And usually when VIX does that, it tends to bounce back up. And this correlation between the S&P 500 and the VIX has been working really well. So we are approaching the upper band on the S&P 500 and the lower band on the VIX, so we might see some pullback. Going back to the advanced decline line, this is the S&P 500. Let's take a look at NASDAQ. So NASDAQ basically did the exact same thing in terms of divergence, and one thing that it's really interesting to look at, we are almost at the point of turning this graph to green to positive, so the stocks making 52-week highs are trying to move on top of the stocks that are making 52 lows, and this hasn't happened for quite some time. We had like a positive day, I think, right here, and two more right here. That's the 3rd and the 4th of January. That's January. So it hasn't been that often this year that we've had such a signal, and we're looking at anticipation to see if we can get that. Of course, if you're following Investors Business Daily, you know that we made a follow-through day, which is one of the signals that this type of trading uses to confirm that this might be actually a valid rally. Now, what you actually have to remember is that if we see a fail of the days past the follow-through days, that usually leads to fail breakout, and we're going to see the market roll over again. So next week or the week coming after, or the week starting from tomorrow, because today the markets are closed for US equities, is going to be very important. And as far as I can see right here in the futures right now, we're moving positive territory for today, because futures still work, although equities are not open due to Memorial's Day in the United States. IWM, you can see advanced decline line also bouncing off the bottoms. There was no divergence right here because IWM made a higher low, so it couldn't breach the low right here. And 52-week highs are moving again on top of the 52-week lows. Last but not least, let's look at Dow Jones Industrial, and you can see the advanced decline line on the Dow Jones Industrial is moving to new higher ground. So it's basically making a new high. As you can probably guess, industrials are stronger than the rest of the market right now. One thing I want you to notice here on the S&P 500 is the volume, though. Follow-through day happens on elevated volume, and we had one right here, but those 2 days, Thursday and Friday, are happening on lower volume, so we'll see if this one holds. Now, my personal opinion, but of course the market doesn't have to comply with my personal opinion. Anyway, my personal opinion that this is just another bear market rally. The macros are still looking towards more rate hikes. The Fed said a couple of 50-point rate hikes throughout the end of the year. Although, and I'll speak about this in my notes. Although the indicators that they are looking like CPE are starting to improve, and they're looking for it to drop to 2.1 in 2024. Anyway, let's go to the QQQs. Look at the chart right there. You can see here volume still not high enough. For me, not above average, that's for sure. So it's up to see whether this can sustain the rally. IWM, volume actually declining, although we are bouncing, volume declining, but we're coming off right into this resistance zone at the 200-day moving average. So it's up to see how this one will go. In Dow Jones Industrial, as I said, we're still below the 200-day, although the advanced decline line is showing new highs. So let's just briefly move so I can show you the put call ratio. Put call ratio, you know, when we get to 1, and here we hit almost 2.5. I think at this day we hit it 2.5. But looking at the white line, which is a moving average, when we get above 1, that means that we are in serious fear market. People are buying more puts than calls for protection, and so forth, so forth. We almost got there, and on faster moving averages, they actually got above 1. Mine never got there, but it was close enough, and definitely the highest level that I've seen since, what is that? That's probably, yeah, that's the COVID crash. So the highest level since the COVID crash was the recent months, and as you can see, we're turning down back towards the medium, which is about 0.75 in terms of put call ratio. We already looked at the VIX chart. As I said, be careful. VIX is approaching the lower band, and the S&P 500 is approaching the upper band. So we might see some corrective action right here. So this is what I have for the markets. And now let's move into my notes. I want to discuss a couple of things before we move into the industry groups. Now, the first thing I want to point out in my notes is that we've actually completed 2 in a row follow-through days. These are Thursday and Friday. And if you look at the chart of the QQQs, this is Thursday right here. This is the first follow-through day, and this is the second follow-through day. Now, O'Neill, the inventor of Investors Business Daily, the starter of this company, was the person to come up with the follow-through day to signal market bottom. So the first 3 days of a market bottoming process, or first 3 positive days are discounted, and then we're looking for days 4 and 5 to see if we come up with a huge thrust on elevated volume. Now, this is the chart of the QQQ, and you are probably asking me, well, what's going on right here? We're now recording 3 positive days. Volume is a little bit lower than it's supposed to be. Now, if you're looking at the chart of the NASDAQ composite, you will see that there are slight deviations from the QQQ, but just speaking technically, yes, we've recorded a follow-through day. Whether you consider those 2 to be instances of such follow-through day, or you take just Friday for it, and you can see right here we have elevated volume. We have a very nice tall white candle in my case, or green candle if you're using green for positive candles. But nevertheless, we can consider this as a follow-through day. Now, again, as I said, the Fed's, their favorite metric for inflation is PCE, which stands for Personal Consumer Expenditure Index. There are other types of inflation you can measure in different ways, like CPI, which is the Consumer Price Index. But in general, in the Fed minutes, and especially the minutes that the staff is talking about how they see inflation, they mentioned that they see this PCE index standing at 4.3 by the end of this year. They have in 2.5 for next year, and 2024 coming down to 2.1, which is the magic number 2, right? So Feds want to contain inflation below this magic number of 2. Now, market reacted to this as if they don't know better. I mean, how many times have the Feds been wrong? And with all this inflation is transitory talk, last year they got it massively wrong. So I still doubt that they are going to get this right, but market just discounted that and said, well, the hell with it, we're thinking that actually they're right this time. So a little bit of euphoria in this bear market. I don't really see the need for that. I don't see the reason for it, because the other things that the Feds said that they're going to continue with the plan of quantitative tightening, as you see, like this QT, right? That's what I mean by saying this, like this QT, and then they're also going to continue with a couple of 50-point rate hikes to try to come up with those numbers right here. So I don't really think that there's that much that much need for optimism here, and this bounce is unnecessarily putting people at more risk, like thinking like this might be the end of it. As I said, my personal feelings are that this is just another bear market rally, and as you can see right here in the chart, there is really nothing that separates this bounce right here from this bounce. We've seen a nice move up, and we still have quite a lot of overhead supply, and nothing really has changed. Like the war between Russia and Ukraine is still going on. There's tensions between China and Taiwan. The macroeconomic situation, inflation, although coming down a little bit, is still not resolved, and we're seeing the Feds are actually factoring in 2 more years of elevated inflation. So to believe that everything is over with in 2 days is going to be childish, but nevertheless, we're traders, speculators if you want, and if we see, as we've said multiple times in our videos and in our Discord channel, if we see the setups, we're going to take them no matter what. As long as you are respective of your stop loss and the risk is calculated before you enter the trade, there's nothing wrong with taking some trades when you see that the market is reacting positively to some news or to some developments as we speak. So this is what I had for my notes. Now I want to also discuss the bounce a little bit. So many people are talking about being a bounce and so forth and so on. Let me just show you Market Smith. I have it right here, I think. So when I was going through the groups, you know, Mark Smith has 197 industry groups. There was this pattern that I see was predominant in quite of the groups, and as you can see right here. So I'm just gonna go start over and just do a couple of them so you see what I'm looking at. This double bottom right here, W recovery type of bounce that I see, and many of the groups participated. That's when we spoke about our risk vest. We saw the stock participation was a neutral, almost putting it to the positive side. Many of the groups just responded, and then we're looking at the charts of the groups right now. Remember, we're not talking about individual stocks. So these groups, they consist of different stocks, and if you are familiar with Market Smith, you can see right here on the information there's like stocks in the group, and you can see what stocks are coming into the agricultural operations group, for example. But you can see there's like this bounce right here, that's an agricultural operation. Apparel and clothing manufacturing, you can see it's doing like well, it's a bad W recovery, but it's still doing something. Then let's apparel, shoes, same thing. Auto manufacturers, same thing. Right from the bottom, just scroll down. Just chemical specialty. These are very strong anyway. Same thing going forward. Communication, consulting services, same thing. But again, hitting into resistance, like this is the 200-day moving average right here. Healthcare, communication services, healthcare, same thing. Pretty much, I've actually went over 700 charts of individual stocks, and a lot of them were setting up for a bounce. Like some of them were, you know, V-shaped recovery, W recovery. Some of them were actually setting up like stage 1 recovery basing formations, computer hardware, peripherals. Even those that are really weak now are jumping on to key moving average for resistance. So it's a widespread bounce. You can see like in computer networking, I mean, that's pretty constructive. Relative strength for the group is at 19. That's really high. Like the top is 100, well, 99. But this is setting up constructively for a bounce. Diversified operations, I don't even know what that means, but you see, this is moving higher. Energy, I'm not going to even look at energy. We know where energy is, but electronics, scientific. This is setting up like a nice mini basing formation right here for a bounce, and even with relative strength of 9, it's going up. Finance, investment banks, same thing. There was the base right here. You can see it right here, and it just bounced off of it. Food, that's been strong. Relative strength of 11, as you can see, it moved higher. There were like a lot of companies moving higher right here into the March and April period, and then it just crashed down. Now relative strength of 11, but again it's staging some sort of a base foods package. This is relatively weak, although it has a relative strength of 83. I don't even know how it got there. Anyway, you get my point. Like a lot of these groups and a lot of these stocks are showing some bounces for the last 4 days of this week, and it's really putting the market into some sort of a trap. I think that a lot of people are going to get long, and then they're just going to bring it back down and kill it before we actually make this move to the upside for real. But anyway, you see what I'm saying. Like a lot of stocks are setting up like this, and for a lack of a better zooming in, I don't know if you're going to see it. Marcus Smith is doing a really awful job of zooming in, but you can see like this is a very tight formation. Medical Biomed, this is a very tight formation right here, and you can see this is like a perfect basing structure. So this can actually be traded, and this is what I have for my notes. Now we're going to look at the industry groups and see what's moving higher and what's moving lower throughout this week, and what is coming up on top of the groups, so we know what we're trading. Then we're going to look at the sentiment, and I'm going to let you guys off so you can continue enjoying this long weekend for you. So for the top and bottom industry groups, again, we're turning to Market Smith, and this time we're just going to look at this category right here and see how many names we have from different groups, so we know what is being added to Market Smith top industry groups and what is not. So just scrolling down the list, we see 2 transportation ship companies, especially these G&K, setting up a really nice setup, so this might be traded this week. We have steel producer once again coming up from the bottoms, so probably not, but I had COF last week actually for short sale, and now you can see it's coming up into IBD's top industry groups. I never triggered that short sale anyway. I don't think it's going to be a surprise. We have here oil and gas exploration for the United States, a lot of companies right here. Also, retail and auto parts, LKU, I actually have this one for my watch list for next week. Again, oil and gas, I don't think that's really a surprise. I will actually be surprised when they add it to the deletions from the top industry groups right here. So we also have metal production, insurance is actually popping up. You have here ACGL, that's one, AXS, ScanSL, TRV. Also finance and property, Bright is coming up. Also what we have here, electric semiconductor. Well, that's interesting. That's new. You can actually see AVGO, favorite of ours, PLAB, some computer software security, and beverages, alcoholic. These have like 3 representatives, so strong category. And pretty much that's it. So I don't see a lot of groupings here, maybe like individual strong sectors, individual strong stocks coming up from different sectors, but yeah, finance property right had like 3, actually 4 members, insurance, another 4 member group, and right here oil and gas, no need to mention it. So yeah, that's pretty much it. Steel producers 3, and steel specialty alloys 2. So if we combine those, we have like 5 companies here. Insurance, as I said, 4, and finance and right 4. And that's pretty much it. Let's look at the deletions. So these are the weaker groups. So companies from these groups are being dropped. Medical Biomed is the first one that's popping up right here, and we have 5 companies from this being dropped. Also, we have finance property right being dropped here, 4 companies. So basically, this group is like just in rotation between the companies within itself, and pretty much that's it. So you can see very few companies from oil and gas are actually dropped. So you have oil and gas, like 4 companies here being dropped, and just 1 in mining and metals. And we saw 5 companies from steel being added back on. So maybe steel is coming into play. Computer software is still being dropped, and chemicals and agriculture, MOS and NTR are actually making their way out of markets mid 250 list. So that's a bit of a surprise. Now let's move on to the sentiment and what I have this week. Now remember this survey, the bulls versus the bears survey, there for the week ending. So this is for not for the week that just ended, but for the prior week. As you can see, their latest data is for the week ending on the 25th of May. And interestingly, it's we made a little bit of a dip back to bearish territory, which is surprising to me. We are still very high off the lows of minus 42.92 that we recorded the week before that, but it's interesting to see how this will transfer for next week, and whether we're going to see a shoot up in sentiment. Now, one thing that I'm thinking, maybe most people by now are aware of the macro situation, so they're not getting overly bullish, which is actually good. If the market is bouncing and the sentiment is not changing, that actually is showing you that market participants are actually aware of what's going on in the market. And I think that the lack of euphoria there is actually quite controversial for the market in terms of the market trying to get healthier. Now again, as I said, for me this is a bear market rally, and nothing really can change it. But if you look at CNN Fear and Greed Index, we're still at extreme fear. Last week we were at 11, now at 21. I don't know what's up with their system right here. It's showing 000s, but I deliberately checked to see if last week we're still at 21. No, it was at 11. So there is a slight improvement, but the good thing is we're still in the extreme fear category. I would be very worried if we get into neutral or greed for just a couple of days worth of positive action. And for Bitcoin, it hasn't changed since last week. We're still sitting at here at 10. I checked the update date to see if actually this is working, but yeah, it's just still 10 out of 100 at extreme fear. And today we're actually seeing some positive action both in Bitcoin and Ethereum, so market might be coming off there for at least a bit. In general, the risk vest, I would put it on neutral. The market and the setups are selective. There are setups that you can actually trade. We are experiencing some sort of a bounce in the market. For me and for us here at Boom Traders, this is mostly a bear market bounce, but nevertheless, the volatility and the put volume have subsided to neutral values, and we are, as we said here, try some at the bottom. We really think that you should try and get into some positions right there, see if it's working. If it's not, some of our positions have recorded double-digit profits already. For me, like the highlight of this week has been P10. I'm already up like 17% on this trade. It's been doing great. I have several other trades that are still in the commodity space, like COP, EQT. If you're following the commodity space, like SQM just rocketed higher, like almost 40%. I was stopped out on this, and they just had to see it go. But there are setups that are actually working, and especially in the last 2 days, pretty much like whatever you bought on Wednesday afternoon has been working for Thursday and Friday. I don't think that anything has actually gone down. So be careful. As I said, we're approaching some resistance zones like the 200-day moving averages, the upper Bollinger Band on the S&P 500. We're also approaching a place where the advanced decline line last time retraced for the S&P 500. So be careful, but nevertheless, I think that it's a good opportunity for you to try and get into some names. Join us in Discord. You will see we have a full watch list of stocks that are actionable for next week. So guys, if you liked it, please subscribe, leave some comments, and of course follow us here, and come join our server in Discord, where you can see a lot of actionable ideas, and of course make some money. So up until next time, I'll see you, and I'm hoping to see you in Discord. See ya. Bye bye.